Crypto made millionaires. Then it made headlines for crashes, scams, and collapses. Once hyped as the future of money, now many ask, is it already over? With the bear market wiping out over $2 trillion in value, fear has replaced FOMO. Over the last few years, the crypto market has gone from explosive highs to brutal crashes. After the 2021 bull run, which saw Bitcoin hit $69,000, came a market-wide collapse triggered by over-leveraged platforms like Terra/Luna, FTX, and Celsius. Millions lost money, and trust in the system was shaken. So it's understandable that people are now cautious, even skeptical. But here's the thing. Every major technological revolution has gone through hype cycles. From the dot-com bubble to the rise of mobile apps, big shifts always come with chaos. Crypto is going through its maturing phase, not a death spiral, and that's why it deserves a second look. To understand crypto as an investment, you first need to understand what it is and what it's not. Crypto isn't just about tokens going up in price, it's the infrastructure of a new digital economy. Bitcoin represents scarcity and decentralized value transfer. Ethereum enables programmable money through smart contracts. Other networks like Polygon, Solana, and Avalanche are building tools for finance, identity, gaming, and AI integration. When you invest in crypto, you're not buying lottery tickets. You're buying exposure to technologies that could redefine how the world interacts, transacts, and governs. Let's talk numbers. Over the past 10 years, Bitcoin has been the best-performing asset class, outpacing the S&P 500, gold, and even tech stocks like Apple and Amazon. Yes, there have been crashes, but Bitcoin has recovered from over 90% drawdowns multiple times. Ethereum has followed a similar pattern, delivering over 100x returns for early believers. Even after major dips, the 4-year ROI remains positive for most top-tier assets. Crypto rewards long-term conviction, not short-term panic. If you zoom out, the trend line still points up, and the market cycles are becoming more structured and predictable. Crypto is infamous for volatility, and that scares many investors away. But volatility is a feature, not a flaw, in emerging markets. It reflects a system still finding its value. While a 10% daily swing can feel alarming, it also creates entry points, arbitrage opportunities, and asymmetric upside. Compared to traditional assets where 8% annual growth is considered great, crypto offers potentially exponential returns, if you can stomach the risk. That's why many smart investors treat it as a high-risk, high-reward satellite allocation within a broader, balanced portfolio. Institutional players are no longer ignoring crypto. They're entering, slowly but steadily. BlackRock, the world's largest asset manager, filed for a Bitcoin ETF. Fidelity offers crypto trading to retirement accounts. MasterCard, Visa, and even Goldman Sachs are exploring blockchain payments, custody, and settlement. These aren't moon boys or Twitter influencers. These are trillion-dollar institutions. Their involvement brings regulation, infrastructure, and legitimacy. More importantly, it signals long-term interest, not speculation. When institutional money flows into an asset, it's rarely about hype. It's about strategic exposure. For years, crypto existed in a gray area, unregulated, chaotic, and dangerous. But in 2025, regulation is finally catching up. The US, EU, and countries across Asia are drafting clear crypto frameworks, how to tax it, trade it, and custody it. While regulation scares some people, smart investors understand that it adds stability and investor protection. It weeds out scams, forces transparency, and invites conservative capital into the space. As rules become clearer, institutions will feel safer investing, and mass adoption becomes more likely. The technology behind crypto is evolving rapidly. Ethereum's merge shifted the network to proof of stake, cutting energy usage by 99.95%. Layer 2s like Arbitrum, Optimism, and zk Sync are making transactions cheaper and faster. Interoperability projects like Cosmos and Polkadot are connecting blockchains seamlessly. AI-powered crypto applications, decentralized cloud storage, and cross-chain liquidity are becoming real. What this means for investors is simple. The platforms are finally catching up to the promise, and that sets the stage for actual utility, not just price speculation. Crypto is no longer confined to exchanges and wallets. It's moving into remittances, supply chains, real estate, and even government infrastructure. In countries like Argentina and Nigeria, stablecoins are used daily to escape hyperinflation. In the US, major corporations are experimenting with tokenized assets, digital IDs, and blockchain-based auditing. NFTs are moving beyond art into ticketing, identity verification, and legal contracts. Crypto is becoming invisible infrastructure like the internet. It's there, even if people don't talk about it every day. Let's not sugarcoat it. Crypto has risks. Hacked exchanges, failed projects, and market manipulation still exist. But traditional markets have risks too. Inflation, political instability, and centralized control. The key difference is that in crypto, you control your assets, which means you're also responsible for protecting them. With the right tools, hardware wallets, two-factor authentication, diversified holdings, and real research, you can significantly reduce your risk. In short, crypto is risky for the lazy, but for the informed, it's powerful. A few years ago, crypto was a mess in terms of user experience and security. Today, it's getting better. Wallets like MetaMask, Trust Wallet, and Ledger Live have improved interfaces and added security features. Smart contract auditing is more common. Multi-signature wallets and social recovery options are becoming standard. For investors, this means you no longer need to be a coder to stay safe. The tools are improving, and security is becoming more user-friendly. Zooming out, the global economy is moving toward digitization. Central banks are testing CBDCs, central bank digital currencies. Younger generations, Gen Z and millennials, are more likely to trust Bitcoin than big banks. Remote work, online payments, and token-based ownership are becoming the new norm. As traditional finance struggles with inflation, low interest rates, and debt, crypto offers an alternative narrative, one of decentralization, transparency, and permissionless systems. These trends aren't slowing down, they're accelerating. Crypto is aligned with where the world is going, not where it's been. Most people lose money in crypto not because the market is broken, but because they try to time it. They chase pumps, sell in fear, or wait too long to get in. History shows that investors who simply held strong assets like Bitcoin and Ethereum over a 4 to 5 year cycle nearly always came out ahead. The key is consistency. Dollar cost averaging, DCA, holding through the noise, and ignoring short-term hype. Volatility is natural, corrections are expected, but the market tends to reward those who stay in long enough to benefit from the rebounds. Crypto can be high risk, but that doesn't mean it needs to dominate your portfolio. Most experts suggest a 5% to 15% allocation, depending on your risk tolerance. This gives you exposure to upside without compromising your long-term financial stability. Start with core assets, Bitcoin, Ethereum, and possibly Layer 1 platforms like Solana or Avalanche. Use stablecoins to park funds and earn yield. Avoid meme coins and small-cap projects unless you treat them as entertainment. In crypto, strategy beats hype every single time. There will always be coins that pump overnight, but 99% of those will crash just as fast. Instead of chasing every new token or influencer tip, look for real utility. Is there a working product, a community, active developers, partnerships, open source code? If not, it's probably short-term hype. Stick with assets that solve problems, not just talk big on Twitter. Long-term investors build wealth by betting on real innovation, not fast exits. In crypto, what matters most is what's being built, not what's being shouted. In a word, yes, but not in the way it used to be. The easy money phase may be over. But what's left is real technology, real adoption, and real opportunity. Crypto is no longer a speculative trend. It's becoming an essential part of finance, technology, and digital culture. If you treat it seriously, manage your risk, and focus on fundamentals, crypto can still be one of the most powerful tools for wealth creation in the next decade. Not because it's new, but because it's evolving into something that finally works. Crypto isn't dead. It's growing up. We're past the meme phase, past the fake pumps and easy wins. What we're entering now is something more stable, more serious, and more sustainable. And that's exactly why it's worth paying attention again.